morning, good afternoon, and good evening, depending on the time that you open this video. So today I want to focus on the course called Advanced Financial Management, but the most important one I will go through for the chapter 1 about capital budgeting and decision criteria. So this is a very good chapter where I help a manager or the owner of institution to decide a project to be investing in. So without delaying, I want to go through it to see what is capital budgeting, what is those methods that we use when you are selecting a project. So when you say capital budgeting, it is a decision process where a manager used to identify the potential of a project or what a value will be adding to our firms. So in a short word as introduction, this chapter it gives us an overview of capital budgeting process and explain the basic techniques that we use when we are selecting a project. So as I said before, capital budgeting, it is also a strategic direction. It is a direction of a company. Or in other words, the absence or the poor capital budgeting will be having a serious consequence for our financial of a company. Now you can ask yourself how this capital budgeting work. So when the organization or institutions trying to use this capital budgeting decisions, it will help firstly to determine the profit that will be benefiting the company. Now you can ask yourself how this manager or the owner of institution selecting a project. So that's why there are 3 common methods that we use. One is payback period, net present value, and also internal rate of return. But that does not mean that it is only 3 methods, but also we have accounting rate of return, we have profitability index. We're gonna see it below. Now, as I said before, capital budgeting, it is a process by which investors use to determine the potential of a project. Now, without delaying, I want to show you the capital budgeting, or to explain to you the capital budgeting rules. So when you are comparing the project with equal lives, there are 7 methods that we use. First one, it is a payback period. Payback period, it is estimated number of years that is required to recover our initial investment. It is a time that you will take to recover your initial investment. Number 2, it is discount payback period. Discount payback period, it is also a capital budgeting procedures that we use for determining the profitability of your project. In other words, it is a number of years that it will take to recover your initial investment. Number 3, it is net present value. As I say, also net present value, it is a tools of capital budgeting that we use to analyze the profitability of your project. In other words, it is a difference between present value of cash flow and the present value of cash outflow for a given period. Number 4, so it is another point that which is called internal rate of return, which help us to decide to check whether the cost of capital is less than the internal rate of return. In other words, when a project have the rate which is exceeding the cost of capital, that project must be accepted. Another point, it is modified internal rate of return. As the name implies, it is a modification of internal rate of returns. In other words, it is financial measures of investment of attractiveness. So without delaying, I want to go first another point or another method of capital budgeting decision that will help us also to select a project. It is profitability index. Profitability index is a useful tools for ranking a project. So in other words, we use this method when we want to rank or to give the rank for different alternative project that you have. So lastly, it is the last point about accounting rate of return. This is another method that the manager or the investor or the owner of the company that you use when you are selecting a project, which means that it is an indicator of a performance, or it is an indicator of profitability that project will giving the firm. In other words, it is the average of net income an asset is expected to generate by dividing also the average cost of capital. So this is, as I teach you now, this is an example which will help us to understanding more about this chapter. So as I say for the previous about theoretically for this capital budgeting decision, we are going now to see the practical one where we do it for calculations, where you see how calculate payback period, discount payback period, accounting rate of return, or the other method that will help us to be selecting a project based on the information. Now this is an example which helps us how to select a project. As you see, this project K has a cost of, this is initial investment of 52,125, and it is expected to get net cash inflow of this 22 per year for 6 years. This is a timeline, and it is cost of capital, it is 10%. Now they tell us to begin by constructing the timeline to calculate this method. The one is the payback period. So as you know, payback period, it is the expected number of times that required to recover the initial investment. Now, payback period as a formula, it is a year before full recovery plus unrecovered cost at start year over cash flow during year. So this is the formula of payback period. As question says, we are going to start by constructing a timeline. So our timeline, as you see, this is 6 years. Now this is the initial investment, which is 52,125. The first year, it is, as you see, it is 22 per year. It means for 6 years. First year is 22. Also second year, it is 22,000. Third year, it is 22,000. 4, it is also 22,000. Fifth year, it is 22 also, and 22 for the last year, which is year number 6. Now we are going to calculate payback period. So without delaying, you know that this is initial investment, must have the negative sign, or we can put into blanket, which means that it is negative. Now this plus this, we get negative 30, 125. This plus this, we get 13. We get 8,125, but negative sign. This plus this, we get 13,875 with negative sign. This plus this, now you see we're going to get positive. It is 35,000. 875. As you see, it is 5, 7. This plus this, 7,500, and also here we have 7,000. 9,875. Now you see this is a timeline for 6 years, and you see it take only the 2 years. So when you reach to 2 years, for the 3rd year we start by getting profit. That's why our payback period, it is a year before full recovery, which is 2 years, as you can see, plus an recovery cost at start year. You see it is this amount, which is equal to 8,125 over this amount of the next year, where we start by getting profit, where you have here a positive sign, which is equal to 22,000. Now, so as you say, this divided by this, or you can put on common denominator, you get 52,125 over 22, which will give us 2.36 years. So as you see, this project K, it will require 2 years, 0.36 years to recover, or in other words, this project, it will require these 2 years to recover our initial investment. So this is about the number 1, about payback period. So we are going to calculate number 2, it is discount payback period. I hope you will understand this. So number 2, as I say, it is discount payback period. This is discount payback period. Now, for this number 2, discount payback period, so we use the formula of NPV. NPV means net present value, which is equal to negative initial investment plus cash inflow 1 over 1 plus R. This R means the cost of capital, which is equal to 10%. Power 1 plus cash inflow 1, N. When you say cash inflow N, it means up to the last year, which is equal to 6 over 1 plus R power N. This is the formula of NPV. Now you see NPV is equal to initial investment, as we say, it is this is 52,000, negative 52,125 plus cash inflow. Cash inflow 1, as you say, it is 22 per year for 6 years. It means every year we gain the income of $22,000. It is 22,000 over, you see, because the cost of capital is 10%, now it is 1.1 plus 22, 1.21. This is 1.1 squared plus 22,1331. This is 1.1 power 3 plus 22, 1.4641. This is 1.1 power 4. 22, 1. When it is power 5, it is 1.61051. And lastly, for 1.1 power 6, you know that timeline is 6 years. It is 22 over 1.771561. And for discount payback period, we don't put on common denominator, but we are going to divide by this, and this up to the last one to get the net inflow of every year, so that we can help us to find this discount payback period. Now that's why our NPV is equal to negative this as initial investment. Now for the first year, we take this divided by this, and you get 20. is 20,000. When you take this divided by this, you get 18,102. This divided by this, you get 16,529. This and this, you get 15,026, and also you get 13,660, and lastly here you get 12,418. So this is our net inflow that we are going to use for calculating this discount payback period. Our timeline now is equal to time 0 for initial investment is negative 52,125. Now for the first year, as you can see, it is 20,000. For second it is 18,182. Number 3 it is 16,529. And number 4 it is 15,026. Number 5 it is 13,660. This is year 5. And lastly, you know that our timeline is 6 years, which is equal to 12,418. Now we are going to do as we do for payback period. So that's why this plus this, we get negative 32,125. This plus this, you get negative 13,943. This plus this is 13. This plus this, you get 2,586. This plus this, it is 17,612. And also this plus this, we get 31,280, mean is 272. And lastly it is 43,690. This is now we're going to calculate as you have do it for payback period. Our discount payback period, this is equal to, you see, we start getting the third year. I mean for the 2 years. Now that's why you take 2. This the year that this is what you call the year before full recovery, which is equal to 2 years plus this uncovered year to start a year, which is equal to 13,943 divided by this inflow for third year, which is equal to 16,529. So as you see now, we get 2.84 years. This is the year that is required to recover our initial investment. This is point number 2. We are going to calculate also number 3 about NPV, or net present value. So I hope you well understand this, and we are reaching on the point number 3, which is NPV. This is point number C. And I hope you still see the question. NPV, as I do it there, it is negative cash inflow or initial investment plus cash inflow for the first year over 1 plus R power 1 plus cash inflow N plus up to cash inflow N1 plus R power N. This is a formula as we do it there. But the difference of this, now here we don't divide this for finding this inflow, but here we put on common denominator for NPV. Now for NPV is equal to, you know, the initial investment is this 52,125 plus For the first year, it is 22 over 1.1 plus, as you see, it is like repeating this that you have done, but for NPV, we don't divide, but we put on a common denominator. Now, 22, 1.21, this is 1.1 squared, 22, 1331, this is 1.1 power 3, 22, 1.46, 41, this is 1.1 power 4, 22, 1.6, 10, 51, and lastly it is 22 for 6 years. You know that our timeline is 6 years. That's why here now the last is 1.77, 1561. I hope you see it. Now, without delaying, I want you to put on common denominator. This is negative 51, 125. We use the last one, which is common denominator, which is equal to 1.77, 1561. Now we're going to take this. We're going to take this, divide by this, and what you get, you're gonna multiply on above. That's why without delaying, I'm going to do it as I show how to do it. Okay. Now, as you can see here, when you take this, divide by this times this, you get 35,431. This divided by this times this plus 32,210. This divided by this times this, you get 29,282. This divided by this times this, 26,620. And also this divided by this times this, you get 24,200. And lastly, when you take this divided by this, it is equal to 1. 1 times this, also you get this 22,000. Now, without delaying, also this is our initial investment plus the total of this. The total of this number, which is above, it is equal to 169,743 divided by this. Now, without delaying, now our NPV, or net present value, is equal to 43,690. But you remember the unit of currency, it is dollars. So, conclusion of this NPV, when NPV is positive, so you accept a project. But when you get NPV which is negative, you have to reject a project. So this is point number 3 about NPV. We're going to do number 4, which is equal to internal rate of return. But I hope you will understand this. So number D, it is internal rate of return. So the formula of this internal rate of return, it is when NPV is equal to 0. This is the formula of NPV. And remember, NPV, as I showed you before, it is negative initial investment plus cash inflow for the first year plus 1 plus, now it is internal rate of return, which is unknown that we want to calculate, power 1 plus cash inflow n, 1 plus internal rate of return power n, and we quote equal to 0. That's why NPV is equal to 0. Now, without delaying, our internal rate of return will be negative. This is cash inflow, I mean the initial investment, which is equal to 52,125 plus 22 for the first year over 1 plus internal rate of return power 1. This is for the first year. 22 over 1 plus internal rate of return power 2. This is for the second year. Number 3, it is for the third year, it is 1 plus internal rate of return power 3, 22. Remember the initial cash inflow, it is 22 per year for 6 years. This is our timeline. Plus 22,000, 1 plus internal rate of return power 4, plus 22, 1 plus internal rate of return power 5, and lastly, because our timeline is 6 years, that's why it is 22,000 plus 1 internal rate of return power 6, which is equal to 0. Remember, internal rate of return, it is when the NPV is equal to 0. Now, as you can see, we are going to calculate this, which is the unknown internal rate of return, which is equal to negative 52,125 plus, now you put common denominator for the last year. That's why we put 1 plus internal rate of return power 6. Now we're going to make summation of this inflow of every year up to the last year for 6 years. So summation of this, without draying, you take this times 6, that's why you get 132,000. Now you see internal rate of return is equal to negative 52,125. Also, let me try to do it first. Now we put on common denominator our, remember here it is equal to 0. Now we put common denominator, now you get 52, negative 52,125 times 1 plus internal rate of return power 6 plus 132,000, which is equal to 0. Now we're going to move this out of here, and our internal rate of return will be equal to 1 plus internal rate of return power 6, which is equal negative, because here it is positive, now it's become negative, this divided by this cost, our initial investment, 52,125. Now you cross out this negative and also take this divided by this. Now our internal rate of return, 1 plus internal rate of return power 6 will be equal to, when you take this divided by this, you get 2.53. Now let's do it for this side. Now we are reaching here 1 plus internal rate of return power 6, which is equal to 2.532. Now when you get case where you have here power, but here we don't have power, so we try to eliminate this power 6 by multiplying 1/6 on both sides. So this 1/6 will be eliminating this power 6. That's why here we have 1 plus internal rate of return power 6 times 1 over 6, which will be cancel and remain by, which is equal to 1, which is equal to, remember we multiply this on both sides. That's why here it is 2.532 power 1 over 6. Now here we remain by 1 plus internal rate of return, which is equal to, it is 2.532. So 1 divided by 6, it is 0.166, many sixes. Now, so 1 plus internal rate of return, it is equal to, so when you take this power this, you get 1.16742. Now you see we are going to take this one out of this side. So our internal rate of return is equal to 1.16742 minus 1, and our internal rate of return will be equal to 0.16742. Now, because our internal rate of return is in rate, we are going to multiply by 100. So finally, our internal rate of return will be equal to 16.74%. So this is our internal rate of return. By concluding for this point, so when we take this value of internal rate of return and we replace here, so that's where you get this NPV, which is equal to 0. So try to do it for proving that it will be equal to 0. So without delaying, I want to go for last point. So we're remaining by 2 points, but the first one before we conclude, it is the point number E, which is the profitability index. In short word, it is PI. So this profitability index, by formula, it is equal to present value of future cash flows over cash flow per period. When you say cash flow per period, means our initial investment. Our initial investment, as you see, it is 52,125. Now, profitability index, present value of future cash flow, as you have seen for NPV, this is the way I will get, it is 100. That's where for NPV, you go for NPV where you calculate 169 743 divided by 1.771561. This is what you call present value of cash flow. The value of this, that's where you divide this cash flow, it is 52,125. Now, that's where you get the value of profitability index, as I hope you see it well. Now, without delaying, we are going to reach on the last point about now calculating this accounting rate of return. I hope you see how to calculate profitability index. Lastly, it is point number 7, which is accounting rate of return. So accounting rate of return, it is equal to average annual income over average investment. Now you're going to see what is average annual income. Average annual income will be equal to average cash flow minus average annual depreciation. So now average cash flow, that's where you remember we have cash inflow of every year, it is 22. It means we have timeline of 6 years. In other words, it is 132, which is summation of 22 for every year times 6, 132,000 over timeline is 6. This is average. This minus the average annual depreciation. Remember our cost is 52,125, and we divide the 6 years to see the depreciation of every year. So briefly, our account average annual income will be equal to 13,312, and also average investment, this point number 2, by formula is it is the cost plus salvage value over 2. And you see this salvage value, it is not given. That's why our average investment will be equal to our cost. This is, as you know, it is our initial investment, which is equal to 52,125 plus salvage value. When it is not given, it is 0. Now you divide it 2. That's why for average investment, it is 26,062. Now, briefly, our accounting rate of return by formula, it is average annual income over average investment. Average annual income, it is 13,312 over this average investment of 26,062, which will be equal to 0.216. So now, as you see, it is accounting rate of return. Because it is rate, you put in 100. So our accounting rate of return is equal to 21.6%. So this is the conclusion of this. But briefly, the purpose of doing this calculation, if you are a manager of a given company or the owner of a company, you need to use this 7 methods so that can help you to select a project that will give you a benefit. So thank you. I hope you understand this about capital budgeting. So by concluding now, I hope you will understand. I really thank you for your attention, and for more explanation, write in a comment below. So thank you.